In this week's video, we'll review the latest charts to help us answer the question, have market fractals flipped to the bearish camp? In the first segment of this week's video, we'll be covering a new market fractal, similar to a market fractal that we've covered in the past, but we will look at it from a different perspective to try to give us some insight relative to the probabilities going forward in calendar year 2018. We've covered this fractal before, so we'll move quickly, and when we get to the definition of fractals, you'll understand why we can move quickly here. This value line geometric index, you get a rally from 1980 roughly into 1987. Then we get a sideways period of consolidation, a breakout, what looks like a failed breakout, some form of a retest, and then a second breakout and a rally. This structure and this shape is very similar to the larger fractal, this structure and this shape. And as we've covered in the past in more detail, you can make an argument that the end of 1994, from a fractal perspective, is similar to the present day or November of 2018. Clients and regular viewers know we've covered this fractal in the past. In fact, this is a chart from a July 2017 video. And a fair question is, does recent weakness in the stock market and the data that we have in hand negate this fractal? Before we move on, this is just a different way of looking at it. This is the 1980 to 1995, 1994 move. Here's the larger fractal, allowing us to see the similarity of the structures. In terms of how it might be able to help us in the present day, let's quickly review some key points from the definition of a fractal. Fractals are self-similar, meaning we are not looking for identical patterns. Fractals speak to similar patterns that recur at progressively smaller scales and assist in describing partly random or chaotic phenomenon. If you've been following the markets closely in 2018, it's probably fair to say that it has felt random and chaotic at times. And notice here, progressively smaller scales. So think of this as a small snowflake that has a very similar structure, not identical, to a larger snowflake. So as we review the charts going forward, we're trying to figure out, does this fractal still apply in any shape, form, or fashion given what's happened between July of 2017 and early November 2018? So to answer that question, you can see here in this fractal, we do have weakness here before the strong rally. So let's zero in on this weakness and this retest type look here and compare it to the present day or November of 2018. Since the S&P 500 is what we're concerned about, our model is built around the S&P 500, we'll be using the S&P 500 in this part of the analysis. 1994, we get a rally. 2018, we get a sharp rally. In both cases, we hit a peak and then we get a plunge. We hit a peak and then we get a plunge. In both cases, we make a bottom and have a relatively strong rally. Put in a bottom and have a relatively strong rally. And in both cases, we come back down in some shape, form, or fashion and retest the original low. We come down in some shape, form, or fashion and revisit or retest the original low. And in both cases, from that retest low, we got a sharp rally. From this retest low, April of 2018, a sharp rally. And remember, we're looking for similar structures. We are not looking for identical structures. As we move forward in both cases, after the sharp rally, we had a relatively sharp fall. After the sharp rally, a very sharp fall. And in both cases, we almost get a second retest of the original low. We almost get a second retest of the original low. And in both cases, we rally before taking out the original low. In the retest low, we rally before taking out the original low and the retest low. So it's fair to say there are some similarities between the pullback and consolidation in calendar year 1994 and the pullback and consolidation in calendar year 2018. This chart is dated November 2nd, 2018. This chart is dated December 30th, 1994. So we can make a logical argument that this point here in 2018 is somewhat similar to this point here in 1994. If you're sitting there watching this video at home, a fair question might be, what about all of the rollover data that we have in 2018? For example, S&P 500 chart dated November 1st, 2018. Price comes down through a flattish and indecisive 200-day moving average, drops below it, and the 200-day moving average rolls over. There's really no way to spin this look here. This is morphing into a concerning look. Do we have anything similar to this in 1994? The answer is yes, and you can make an argument that the trend in 1994 is weaker than the trend here. How can that be? When price goes through the moving average here, this is a very flat moving average. If we look out here, it's bullish. Not the case here. We have a downward sloping 200-day moving average. This trend is weaker when price goes through it. Is there anything else that's different between the two periods, 2018 and 1994? Yes, when we look at our fractal, the consolidation period in the first case with the small fractal is about 7.8 years in here. We know the longer we go sideways, the bigger the move we can expect to get. Since this is the much larger fractal, we went sideways for quite a bit longer. 19.2 years is quite a bit longer than 7.8 years, telling us it's prudent to keep an open mind about much better than expected outcomes. Because this consolidation period here tells us if we get a move in this direction, it could be more significant or have a greater magnitude than what happened after this point A. What did happen in the 1994 case after the very, very similar setup? So if we expand the chart from point A, which is in this case December 14th, 1994, the market rallied for 1, 2, 3, 4, 5 plus years, and the gain from point A to point B was 236%. And from a closer perspective, we've just shown you can make a case 2018 is similar to 1994. And from a bigger picture perspective, here's our small fractal. Here's the end of 1994. Here's our larger fractal, giving us some perspective. Point A in the present day, November 7th, 2018, you can make an argument is similar to this point A in this area here. Notice we are using the word similar. We're looking for similar structures, not identical structures. Is there any other evidence that tells us the net aggregate opinion of all market participants in the present day might be similar to this concerning look here in 1994? So let's compare point A to point A again, this time using weekly charts. This is December 22nd, 1994. It's 2 weeks into a rally off the low. November 8th, 2018. It appears that we're 2 weeks into a rally off of a similar low. Whether this is a real low, that's to be determined. Let's just walk through pattern recognition. 1994, CCI goes from overbought to oversold to overbought to oversold, and then sneaks above negative 100. Overbought, slips into oversold, back to overbought, back into oversold, and look at the look of this. This is very, very similar to this look here on November 8th, 2018. ADX, we have that sleepy, trendless market with ADX black below both green and red. Present day, ADX black was recently below both green and red. The Copic curve goes from above zero to below zero to above zero to below zero. Above, below, above, below. Look at the look of this, hovering right around the zero line, and the look of this hovering right around the zero line. Again, we're not looking for identical patterns, similar patterns. These are unquestionably similar patterns. If you're still not convinced, similar situation with MACD. If we compare the whole period, they're similar, but let's look at the end. 2 weeks into the rally, we have MACD rising near zero. 2 weeks into the rally, we have MACD rising again near zero. The only difference is MACD is below zero here and slightly above here. The trend in the present day is stronger than it was here. Similar situation with RSI. It's up near overbought territory. Overbought. Fast forward to the end of the year. We're trying to recapture 50. We're slightly above 50. In the present day, we're trying to recapture 50. We're slightly above 50. Rate of change, very similar for the whole year. At the end of the year, we're coming back up and knocking on the door of zero. Coming back up and knocking on the door of zero. Still not convinced. We can go through all of these. Williams percent R, very, very similar. Let's just look at the end of the year to speed things up. Oversold, recaptures negative 50. Present day, oversold, recaptures negative 50. TSI trying to turn back up near zero. TSI trying to turn back up near zero. Tricks, black below red, hovering around the zero line. Tricks, black below red, hovering around the zero line. Full stochastic gets a bull cross. Full stochastic gets a bull cross. It occurs near 20. It occurs near 20. We unquestionably have similar patterns on multiple time frames, very long-term time frames and shorter-term time frames, and have similar patterns in the battle between the bulls and the bears. And all this helps us with is this. If it's possible that really good things happen from that low in late 1994, then it's within the realm of possibility that really good things could happen when a low is made in the present day. We're not assuming that the low is already in. It is possible here that there's more pain ahead, but what that tells us is even more pain ahead wouldn't necessarily throw the longer-term fractal out the door. It's extremely important to note we are not using this as a forecasting tool. This is simply a tool that helps us keep an open mind about better than expected outcomes. Given the inflection point data that we have in hand in November of 2018, it's very, very easy to keep an open mind about worse than expected outcomes. Our human tendency is to extrapolate. It was also very, very easy to keep an open mind about worse than expected outcomes in 1994. And like the low in 2016, those that were able to push their ego aside, not worry about getting whipsawed and not worried about looking wrong or stupid in the short term, if you did all that and you realigned yourself with the trend, it's possible there could be very, very satisfying gains in the years ahead. And since these are similar structures, We are not using this to try to predict the path of stocks going forward. We're simply saying it could be similar. That's it. Not identical. We won't be watching this analogy to see if it's holding up. Nothing like that. In fact, this won't alter our approach in any shape, form, or fashion and has nothing to do with the model. It can help us execute properly because proper execution requires maximum flexibility and having an open mind about all outcomes. And the purpose here is not to compare the fundamentals in 2018 to 1994. Are there significant differences between this point here fundamentally and this point here? Absolutely, positively, yes. Just as there was a unique combination of fundamentals during this bull run here, fundamentals that were quite a bit different than the combination of the fundamentals here in this bull run. And if this bull run continues, we have a unique combination of fundamentals in the present day. The fundamentals are different here, they're different here, and of course they're different here. There are no two periods in human history or stock market history that are identical from an interest rate, inflation, valuation, earnings, multiple perspective. It's different here, it's different here, it's different here. What's the same is we're getting a shift where the net aggregate opinion is negative and long-term it shifts to positive. The net aggregate opinion about all topics on all time frames is negative, it shifts to positive. We have a similar and constructive look in the present day as of November 1st, 2018, and since we're up between Monday and Thursday, this chart looks better on November 8th, 2018. Are there any other reasons to believe that we could be trying to put in a low in the present day similar to this low in 1994? Yes. As we've covered in our Twitter feed, there are favorable seasonal patterns and cycles for the next 2 to 12 months. To simplify things, you can Google 5 midterm charts and see this excellent post on LPL Financial's website. We also have numerous setups in the present day. This one from Ashbury Research, basically saying that the put-call ratio in the present day looks very, very similar to recent lows. And maybe more importantly, we now have follow-through. Setups are nice, but we need the market to prove something. It has proven some things, including having 3 consecutive 1% up days that look very, very similar to recent major lows. This is a setup. This is somewhat of a confirmation of the setup, the market proving it to us. Why is this second piece so important? Because if we just have setups and we don't wait for the market to prove it, it's possible that really, really bad things can happen, like losing $200,000 in one day. We covered Black Monday in last week's video. And recently, prior to the market proving it, we had setups with no proof. And setups with no proof can be really, really dangerous. And we noted that on October 26th. Setups are just that, setups. They must be followed by some prove-it-to-me action from the market. May happen soon, hasn't happened yet as of October 26th. Different story on November 1st. We have some prove-it-to-me evidence. Why is that so important? Let's look at a very, very easy example. This is S&P 500 monthly chart. This is June 20th, 2008. You can see here Williams percent R for the first time slips into oversold territory. And that's point A here. This is just a blown up version so we could see where the stock market was trading. So when the S&P 500 was trading at 1317, we could have said We're oversold. The market is due for a bounce. Let's fast forward. How helpful was that? Well, we're oversold. We're due for a bounce. Let's fast forward. We're oversold. We're due for a bounce. In fact, now we have a bullish divergence. So we should be patient, or maybe we should buy here. Let's fast forward. Was that helpful? Market hasn't really proven much of anything. We're still down in oversold territory. If we fast forward, still don't have any significant bounce on the monthly chart, and we have, for the most part, been oversold for several months. A setup is useless until the market proves it. If we fast forward, it continues to get ugly, and it's not over yet. Market continues to fall into 2009. We're way oversold. We've been oversold for the most part for several months, as the market hasn't rallied at all. Hasn't proven much of anything in here. If we fast forward, we finally make a low, telling us that it can be very, very dangerous to assume that any type of setup is automatically going to morph into a low or a bounce. From this point A, where we first went into oversold territory, the additional loss, we dropped from 1317 down to a close of 676. So if we kept guessing in here, we would have been guessing during a 48% loss, additional loss between point A and point B, which is why it's so important to wait for the market to prove it. During the trading session on Friday, November 9th, the S&P 500 retested a gap. If you viewed the CCM Twitter feed on Friday, some of these tweets may have possibly sparked a question. Rather than cover the tweets, you can find them in our Twitter feed. You can just Google @Shavako Capital or Shavako and Twitter. Anyone can look at the feed. So before the market opens on Friday, 7:04 a.m., we might test a gap, basically, which means the market would fall somewhere between 32 and 50 points during Friday's session. And sure enough, during Friday's session, 1:20 p.m., the S&P 500 was right inside of these two numbers, down 34 points. If you're a client, that might spark a question. If you knew there was a gap, why didn't you wait to do the buying that we did the day after the election? Well, that's a fair question, and there is an answer. Markets like to fill gaps. There are some caveats. Here's a gap up, S&P 500, October 2014. Here's the high. There's a gap between the high and the low the next day. So let's assume on October 21st, 2014, we knew the S&P 500 had a gap open, and we decided to stay in 100% cash because we know that the market always retests or fills gaps. Why can that be a dangerous strategy? Markets do like to fill gaps. How long did it take to fill this gap? And what happened after this point here? The answer is, if we stayed in 100% cash because we knew with 100% certainty that the market was going to come back and fill this gap, we would have missed a 9.51% gain from the close on this day here to this peak here. And that gap was not closed for 211 calendar days. And this is why gaps are not a big part of our process, and gaps have nothing to do with the inputs relative to the model. They can be helpful from an implementation perspective, and they can also be harmful. During the session on November 9th, we did indeed fill that gap. The S&P 500 was down 25 points, and I can unequivocally say Friday was a good session for us. Why would we ever root for the market to go down? During the session, we filled this gap. We don't have to worry about it now. Why is that important? Because if we didn't come back and fill the gap, for the most part, during this entire move here, we would have been looking over our shoulder, tossing and turning at night, and wondering how long it was going to take for the market to come back and fill that gap. Having an unfilled gap tells us there's a higher probability of a reversal, which is exactly what happened in this case. The gap was indeed filled, but it wasn't filled for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months roughly. So the fact that the gap was filled on Friday is good news, because now we don't have to look over our shoulder, and now the odds are higher that we could get a sustainable rally and never come back and revisit that gap. We also learned something on Friday's session. When we come back to the gap, one of two things typically happens. Buying conviction picks up and the market rises, which is what happened on Friday. We closed above the gap. Number two, this can act like an air pocket and selling conviction can pick up. That didn't happen. And all things being equal, that's a good sign. Friday's session also had decent market breadth. This is the close, November 9th, NYSE new highs, new lows, -2. Contrast that with the horrible -525 down here and -500 here. This tells us that we have very unbalanced run for the exits conviction on the bearish side of the ledger relative to the bullish side of the ledger. These numbers up here tell us that bullish conviction has picked up relative to bearish conviction. And now, unlike this period here, we have some stocks making new 52-week highs. This is anecdotal evidence. However, it is good to see something like this, anecdotally. Here's the S&P 500's low in February of this year. Notice our new highs, new lows down below -450. This is very, very similar to these readings down here. Eventually, we come back up around the zero line. And what's noteworthy here, we've put in a low. Once we get here, we've made the low and we move higher from there. Even on the retest, we come back and never hit this level. Doesn't guarantee anything in the present day. It just speaks to improving probabilities. This is what you want to see during a bottoming process. And notice, we weren't out of the woods here. We still had a lot of volatility, came back down. We just never exceeded this low. We've seen numerous forms of incremental improvement during the past few trading sessions. In fact, we posted some examples of that on short takes on election day, before the election results were known. Those charts told us to keep an open mind about better than expected outcomes. This is our 30, 40, and 50-week moving averages, generic moving averages, to illustrate basic concepts. This is emblematic of our inflection point data. This was down, it's turned back up. That's good news. However, it could easily turn back down. So rather than go through chart after chart after chart showing incremental improvement, it's better to just say we have incremental improvement in numerous areas, but it's important to keep an open mind. We're not out of the woods yet. Here's another chart that would help us keep an open mind about worse than expected outcomes or ongoing volatility, even if this is a bottoming process. So here's a move, an A to B move from the all-time high to the recent low. If we're in a bear market, this would be a normal retracement within the context of a new bearish trend. Well, this is a mixed bag so far. We've exceeded the 32.8, the 50, but we have not exceeded the 61.8% retracement yet, telling us to keep an open mind about an ongoing bottoming process and or morphing into a bearish trend. You can even see here, we have this in our Twitter feed. You can go look at it for the futures. But this could be a left shoulder, this could be your head, and we could now be forming a right shoulder, telling us it would be very, very reasonable for the market to come all the way back down to this level here around 2,700, and we could still be forming a right shoulder. Nothing's really changed on this front. In last week's video, we said the further we move away from this low, and this is last week's chart, we have moved further away this week. The S&P 500 was green this week in a big way. That allows us to focus on the longer term trends. But everything we said last week still applies. If the market gets back down in this area here, we'll be looking at the data. And if we come down and make a lower low, which is still a possibility, and that could even be a retest situation, we have to keep an open mind that we're still near an inflection point that appears to be resolving itself in a bullish manner. But it's still a fluid situation. And history tells us it's extremely important to keep an open mind and understand that until the market tips its hand in a more definitive manner, it's possible that we might have to increase our trading frequency if we move in this direction, still could experience some whipsaws, and could be dealing with emotional swings. Our preference now is to try to shift back to a volatility to ignore bias as long as the data and the market allows us to do that. We unequivocally have improvement and signs of a potential bottom, but that statement is based on the facts that we have in hand as of the close on Friday, November 9th. So everything that we've talked about on short takes and everything that we've talked about on our Twitter feed will still apply as we head into next week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.